We have assembled a fantastic panel of distinguished speakers together with a moderator whom I'll introduce in a minute for today's discussion. I'm Bill Maurer. I'm the Dean of the School of Social Sciences here at UC Irvine. And this webinar format is something we got pretty comfortable with during the pandemic. And so we're going to keep going with a series of virtual events for the foreseeable future, as well as hybrid and in-person events, so we can welcome you all back to campus where things are hopping once again. Today, we are joined by economists from UC Irvine's faculty, as well as the San Francisco Federal Reserve. And I also want to acknowledge the presence here of Bill Branch, professor and chair of the Department of Economics here at UC Irvine, who helped facilitate today's event. Our speakers, I'll introduce them in turn, and then I'll hand it over to our moderator. We have Nicolas Petrosky-Nadeau, the Vice President for Macroeconomic Research at the Federal Reserve Bank of San Francisco, where he studies changes in aggregate labor markets in the longer run and over the business cycle. Nicolas got his PhD from the University of Quebec at Montreal and Sciences Po in Paris, and was on the faculty at Carnegie Mellon before joining the Federal Reserve Bank of San Francisco as Vice President for Macroeconomic Research. And Nicolas, thank you so much for joining us here today. We also have Professor Gary Richardson from the UC Irvine Department of Economics, who is a macroeconomist who studies the history of the Federal Reserve. Professor Richardson got his PhD from Berkeley, and in addition to serving here as a professor, he's also a research associate with the National Bureau of Economic Research. Finally, among our panelists, we have Professor Eric Swanson, who studies monetary policy and the relationship between financial markets and the macroeconomy. He got his PhD at Stanford and served as a senior economist with the Federal Reserve Board and senior research advisor at the Federal Reserve Bank of San Francisco. And he is also an associate with the National Bureau of Economic Research. And moderating our discussion today will be Peter Trepp, an alum, UCI class of '88, UCLA Anderson, MBA class of '98, CEO and founder of Validiti Technologies. Peter's a tech entrepreneur and former investment banker, and his current venture, Validiti, is the world's first private digital wallet that's working to disrupt the personal data monetization market. He's the author of a book, The New Rules of Consumer Privacy, and got his bachelor's here in econ at UCI and his MBA at UCLA. Here, he's also a member of the Board of Counselors for the School of Social Sciences. And Peter, I'm delighted to now hand this over to you. The webinar is being recorded. If those tuning in would like to pose questions, please put them in the Q&A box at the bottom, and I'll be helping Peter manage those as we come to the end of our hour together. Thanks again for being here. Peter, over to you.
Thank you so much, Bill, and I'm delighted to be here and so happy to have our panelists here today as well on this rainy November day in Southern California. I'm glad everybody turn their clocks back, so we all arrived on time today. That's great. You know, we've been, so many of us have been thinking about the economy, and it's a big topic, and there's a lot to discuss there. We tried to narrow it down a little bit and find some subjects that were particularly relevant, and it's going to be a lot to discuss inside of an hour. But I thought we'd start off by talking about today. We're gonna let our panelists talk, but our topics today are going to cover the recession. We look back past economic cycles and recessions the last about 18 months. Historically, a lot of questions about whether this is going to be a cycle or not. We were sort of technically in a recession a couple of quarters ago. But a lot of economists are saying it looks like the worst is ahead of us. And we're going to segue into interest rates. Last week, of course, raised interest rates. Chairman Powell indicated that rates are going to be higher than we originally expected and probably last a little longer. And of course, the markets reacted somewhat negatively to that, not surprisingly. But both investors and some economists are saying, let's not go too far. There's a lot of downside by going too far here. Talk a little bit about how consumers. And then the last area we're going to cover is international events. We'll talk about like the pandemic and shifting into declines in the numbers. We have another new prime minister in the UK. Ukraine continues to defend itself from Russia. Russia is shutting off natural gas sources in Europe. A lot of things going on the international stage. The question is, are we teetering on the edge of? So before we get into all of that, I'm going to invite our panelists to talk about the economy and some of their thoughts. And Nicolas, would you like to go first?
Yes, gladly, Peter. Just first of all, thank you for the invitation to attend this panel with Gary and Eric. Thank you to you and Bill and UCI. I am going to share some material. Now, hopefully you can see our habituation to remote technology, and this is successfully shared and everyone can hear me clearly. I thought I would begin by, I think, a little preamble, which everyone is very much aware of, as we've been it was in Peter's opening remarks, and it's been in the conversation for the last several months, and is top of mind for many American households, is that inflation remains elevated. It is elevated and remains elevated. And at the same time, the labor market is very strong. Now, I have a few minutes today just to talk about what we are seeing and how we're thinking about the outlook for the US economy. And we are seeing some signs of slowing demand that are emerging. And I'll close by walking through how we in San Francisco are thinking about the potential for a soft landing during this tightening cycle. And I'll try to be a little bit clear about what I mean in this context with respect to slowing the economy at a rate that is sustainable without a hard stop in the labor market. Now, we've all been living this in our pocketbooks over the past year. Inflation, if we look at overall inflation, this is personal consumption expenditure, so it covers all goods and services in the economy, is simply very high, the highest it's been in 40 years. Even if we strip away volatile elements such as energy and food, core inflation remains elevated. And this is not something that everyone had fully anticipated, even though we are in a labor market today that is historically strong. Now, if you look at the labor market that we had printed in the last jobs report last Friday with an unemployment rate of 3.7%, that's an unemployment rate that is at historic lows and puts our US labor market more or less where it was prior to the start of the pandemic and us all having to work from home during those first at least 24 months and sometimes longer. Now, a strong labor market prior to the pandemic and in past business cycle expansions has been essential for undoing a lot of the damage that are caused by recessions. And this recession was no different, with the exception that it affected some workers and some demographic groups harder than they typically had been in prior recessions. We had services that required an in-person or a presence shut down, making work impossible. And those affected a lot Hispanic communities and lower workers with a lower level of education. But the disruptions to our schools and childcare services also meant that there was a gender component to the recession that was quite different from prior recessions. And we saw employment losses and drops in participations for mothers that were outside the historical experience. Now, this chart that I'm showing you here is an example of the change in employment for mothers during this episode. And all the three groups I'm showing here are all indexed to the start of the pandemic. They're all equal to 100 at the start of the pandemic. And so you can see that drops in employment for some groups, for example, Black and Hispanic mothers, dropped by over 15%, which is just absolutely enormous. But what is particular here relative to men and fathers is the lag with which the recovery took place. There was a long period of time in 2020 when schools were still shut down, in which the recovery in employment for mothers took longer to catch up. And it is only, especially in the last 16 months, where the economy has been enjoying a long expansion with a very low labor market, that much of the hardships that were induced by the pandemic have been undone. So those are the benefits of a long expansion with very low rates of unemployment with a strong labor market. And they do take a certain amount of time to materialize. That said, in this context, which is very different from 2018 and 2019, we're faced with very high inflation. When we all moved to working from home, there was a dramatic shift in our consumption expenditure patterns. We went from spending a lot of our disposable income on services and going out to restaurants, on hotels, and travel, to buying things for our homes, new computers, new desks, extra patio furniture, purchasing goods. And what we ended up being confronted was a surge in the demand for goods and disruptions to the supply for these same goods, either because of lockdowns in China and in their attempt to contain COVID-19 pandemics, or simply the constraints of needing to ship so many more goods than had been the prior experience. And so we saw a lot of inflation in goods in 2021 and early 2020. Now, this inflation appears to be slowing down, and we have all returned to consuming more outdoors and with in-person services, and we're beginning to see a pickup as well of inflation in services. Now, in contrast to the labor market of 2019, what this means is that inflation is beginning to erode the recent welcome wage gains. So this chart is showing a very clear illustration of that. It's the average, the typical weekly earnings for an American worker indexed to January 2021, right when inflation really started picking up. And nominal wages, what people are taking home, really increased a lot in the last year and a half by about 6%. But when we factor in price inflation, we see all of those wage gains reversed. In fact, real earnings have been declining over the last year and a half, and materially. And this is affecting workers in different occupations and different skill sets differentially, as their earnings are keeping up more or less with the inflation for the goods that are a larger share of their consumption basket, what they take home. So take, for example, food and shelter is a component in inflation that have recently been increasing very quickly, and they're a larger share of the consumption basket for lower and middle income households. So as a result, policy, in particular the FOMC, began a tightening cycle. On the first increases in the federal funds rate in March of this year, but had started communicating the beginning of a tightening cycle quite a bit earlier and into late 2021. And you can see this effect of this communication, this forward guidance of their policy actions, showing up in interest rates that affect business investment decisions, household mortgage application decisions rather early on. So the green line is showing you the yield on 2-year Treasury notes, and the light blue line are 30-year mortgage rates. You see those started increasing earlier and very rapidly than the actual increases in the federal funds rate. Okay, so, but the real question, and one of the questions we are going to be discussing today is the Federal Reserve going to be hitting the brakes very hard, and so hard that it will be very damaging to the economy? Can monetary policy slow growth without a large increase in unemployment? And one element that's crucial for thinking through this is the typical trade-off between lowering job openings, so lowering demand for workers, which is one of the intended consequences of bringing supply and demand in the goods market into balance by tightening monetary policy, with higher unemployment. And just for a little bit of context, right now, the amount of jobs that are unfilled in the United States are outside the historical norm. There are about 10 million unfilled vacancies that firms are trying to fill. And that's about 1 2/3 more than unemployed workers looking for work. Now, this has been coming down over the last 6 months since the peak. And we also see signs of it coming down earlier in specific sectors that are very large employers, such as in business, professional and business services. But what will it mean if the level of job openings comes back to where it was prior to the pandemic? Will this necessarily imply, as jobs become scarce, a big increase in the unemployment rate? Now, luckily, to help us think through this problem, we have a lot of historical data. And this is something that one of my co-panelists knows very well. We have good data that go back over for 100 years. And in this next picture, what I'm showing you is the US experience in terms of unemployment and job opening rates since the 1920s. So nearly 100 years of data. And what you see is very intuitive. When job openings are high, which is on the y-axis, it's relatively easy to find a job, and unemployment is low. But when the economy slows down and job vacancies are low, it becomes hard to find a job and exit unemployment, and the unemployment rate tends to rise. Now, there are a lot of data points here, all in gray. And what I'm focusing on here is a more recent experience from the 2007 to right prior to COVID, because our economy today is probably closer to that experience. And the big question is whether this relationship follows something that's very linear. So whenever the job openings will fall, there'll be a big increase in unemployment, or if there's some degree of curvature. And what we have been doing at the Federal Reserve Bank of San Francisco is thinking about this and what's the best fit to explain the data when we think about the historical experience. And we think about our models for thinking about the labor market. And that corresponds to this yellow curve. It means it's representing the fact that as firms are trying to recruit more workers and workers become scarce, it becomes commensurately and increasingly hard to fill workers. And think about all of businesses who have been reporting the difficulty in finding workers right now, and increasingly so. Well, that's captured by the fact this yellow line, as unemployment becomes small, it becomes very steep. Now, what has been the experience over the last few months? Well, I've highlighted a few data points. And the first one is March of 2022, when we had the historically high job openings and historically low unemployment. The last 6 months since have seen declines in the job openings without any material increase in unemployment. And this is where we see a certain path does exist for the economy to cool down, job openings to return to a pre-pandemic level, and an unemployment rate that perhaps could settle around 4.4, 4.5%. Now, granted, this will mean fewer jobs for individuals, but it is a situation in which inflation will be back into better balance, and the economy will be able to give people real wage gains and have an economy that works for all workers. So that concludes my opening remarks. I want to turn it over back to Peter.
Thank you, Nicolas. That's really interesting, and about how we're going to reconcile some of these back into that. Gary, would you like to say a few words?
Yes, and I'm going to go ahead and share my screen. Okay, can you guys see my slides? Okay, so I want to thank you guys for inviting me here, and thank the audience for participating. Okay, so I used to be the official historian for the Federal Reserve, and so when I think about modern macroeconomic issues, I tend to think about historical analogies, and then kind of take the modern situation and put it into the past and try to make predictions for what might happen today from the range of experiences we saw in the past. But trying also to keep in mind that the economy has evolved over time, and that our ability and economic science and our ability to conduct economic policy has improved. The historical analogy I'm going to share with you today, I'm going to make 3 points, and it's going to be, I think, more of a cautionary tale than the tale that, that Nicolas just told us. The first point I want to make is that the amount of economic stimulus that's been applied to economy since even before COVID, and that continued through COVID and continues today, has been really unprecedented in historical terms. And I have two figures here to show you. One on the left looks at fiscal policy by measuring federal deficit as a share of GDP. Sorry, the axes might be a little hard to read on your screen, but I'll describe the graph. So the graph is going to show you the federal budget deficit. The black line is the balanced budget line. So above that line, the government would be in surplus, and below that line, we're in deficit. And if you see today the federal government budget deficit, right, it's unprecedented in its size relative to our economy. We're running a budget deficit of about 15% of GDP. A lot of that has been these budget deficit we've gotten used to, and it's gotten a lot larger with the Trump tax cuts and then with the government expansionary policy during COVID. So fiscal policy is unprecedentedly stimulative. The other thing we see is monetary policy, and I'm going to measure the stimulus there by looking at the real interest rate, which is the nominal interest rate minus the rate of inflation. The monetary policy is also incredibly stimulative when you look at this in a long run perspective. So here the graph is plotting the real interest rates back through the end of the 1970s, and you see the real interest rate, it's fallen over time. We've gotten used to these low real interest rates. But since COVID struck, right, we've had real interest rates that are substantially below zero. Now here I measured the real interest rate in a kind of simplistic way that you average consumer might do it by comparing the 30-year rate on a 30-year fixed mortgage to the consumer price index. But there's a lot of more sophisticated measures of the real interest rate. And here I plot 3 from the Cleveland Fed, which show that the real interest rate at almost any different time horizon is negative now, or substantially negative, and very low from historical perspective. So when you look at the economy and you see, right, that we're getting inflation, one kind of approximate candidate for us getting this inflation now is that the government, both the monetary authorities and the fiscal authorities, are stimulating the economy and driving up what we call aggregate demand. So in the past, when economy received large stimulus like this, and stimulus that had been larger than we'd seen in the past, we'd often got inflation. And for these inflations in the past to stop, we had to end the stimulus. So I'll give you just a graph about this. Here's a comparison of the inflation rate and the Fed funds rate from World War II until essentially today. So the blue line is the federal funds rate. So this is the kind of overnight interest rate that is controlled by the central bank. And the red line is the inflation rate. One thing to note is, generally so the inflation rate is in blue, the Fed funds rate is in red. So normally you should see the Fed funds rate is above the inflation rate. So we have a positive real interest rate. And today, we're in a situation which we haven't had much over the last 60, 70 years, where the Fed funds rate is really substantially below the inflation rate. And then you say, well, what do we need to do? What did we do in the past to control inflation when it got high? We moved the Fed funds rate and other interest rates that are influenced by the central bank substantially above the rate of inflation. So we created a positive real interest rate. And so here I've squished the top graph down, and then I've plotted the difference between the red and the blue lines in the top graph as the red line on the bottom graph. And this is just the real federal funds rate minus, which is the Fed funds rate minus the rate of inflation. And you can see in the points in time when we brought inflation down, we got this kind of simplistic measure of a real interest rate substantially above zero, something on the order of 5 to 8%. And so historically, to slow the economy, right, and bring inflation under control, we had to get the real interest rate up around 5 or 8%. Now, maybe there's reasons to think we don't have to bring the real interest rate up that high now, and it's possible. But right now, the real interest rate, depending on how you measure it, is probably zero or negative. And so we probably need to raise the real interest rate still substantially. So that's one of my kind of first messages. I think we're still overstimulating the economy, both fiscal and monetary policy, and we have to probably do a lot more to slow it down. Now, the fact that the economy was experiencing inflation, right, this is in part caused by, or the general cause is there's an imbalance in supply and demand, right? We have aggregate demand too high relative to aggregate supply. Many people will tell you part of the problem has been these temporary shocks that we've experienced to aggregate supply that have temporarily disrupted the economy and caused some short-term impetus for inflation. And that's there's a lot of truth. We see these supply shocks, but some of these shocks may not be temporary. But some of what we see is just the image of, or the symptom of, having too much aggregate demand, and then the supply chain can't fulfill all our desires. But some of these shocks could be longer term or even permanent. The disease environment, it's gotten a lot better, but COVID isn't necessarily over. We have a lot of new variants that are emerging, and there's a lot of countries around the world, particularly China, whose economies are still disrupted because of their responses to the pandemic. Now, China is an example where, in part, the pandemic is triggering the disruption, and in part, it's the changing political situation. The other kind of source of these supply shocks that people are talking about, like the war in Ukraine and problems in China, is the rise of nationalism, right? Tensions among polities have increased really dramatically in the last decade. And nationalism is really seems to be contributing to fragmentation of the international system, rising barriers to trade and migration into capital flows. This can lead to substantially lower potential output for the world as a whole. In the best analogy for the recent rise in nationalism, and where you could look for a mirror, is the rise in nationalism a century ago in the early 20th century, right, which turned a thriving international economy into an economy that struggled for 2 generations to generate growth for much of the world. And we had huge swings in prices in different countries. We had a lot of hyperinflations. We had really substantial deflations. We had 2 world wars, and it took a long time to get us out of the economic situation caused by the rise of nationalism. So I would say I'm sanguine about the prospects of our economy and the national economy. We have very well-intentioned people working at our central bank, and they're very smart, and they're going to do a great job, or as good a job as you can. But there's a lot of, and there is a possibility that we're going to have a soft landing. But I think it's far from certain, right? The central bank has made kind of a couple of key mistakes in the past, and they could be making the same mistakes today. So the big mistakes they made in the past are being too optimistic about the natural rate of unemployment. Right now, they're telling us it's about 4%, but a few years ago, they said it was 5 or 6%. And if the supply shocks the world is experiencing are permanent, it could be higher. So second big problem that the central bank can do is misinterpret the nature of the supply shocks, right? If they believe supply shocks are temporary, but it turns out they're permanent, then actions which would have balanced the economy, right, can actually make the economic environment worse. And the last issue, that we might have is that our central bank might not well coordinate its policies with other economic agents and other policymakers, like our federal government or international central banks or international governments. And we have a lot of challenges there too. So I'll end in saying thanks again. And I don't want to be too pessimistic, but I do think there's a lot of risks for our economy and the world economy and in the months and years ahead.
Yeah, well, I think there's room for caution here, and for good reason. And I think a lot of what you point out there are reasons why we see a number of economists disagreeing about where we are and how long this is going to last and how deep it's going to go. We have some people saying this is going to be a V because there's been so much infusion of capital in the market, and others saying it's going to take much longer than that. I'd like to get into that a little bit more. But Gary, thank you very much. That's terrific. Eric, I'd like to invite you to share your thoughts.
Okay, I'll share just 3 slides that I prepared. Let me know if you can see them. Okay,
We got it.
good. So everybody can see that.
Hmm.
So now there's a table. So I have 3 slides. The first one is this table. And what I'm reporting here are some of the major measures of economic output in the US or economic activity in the US in 2022. So I've done it here for each column is the first quarter, the second quarter, and the third quarter of this year. In the first row, I have gross domestic product, obviously. Then I have industrial production. It's another measure of economic output in the US. And that's a monthly statistic, but I've converted it to quarterly and converted it to annualized growth rates so that it should compare 1-for-1 to GDP. So these are like an apples to apples comparisons of these different numbers. In the next row, I have non-farm payroll employment. It's total employees on non-farm payrolls. Again, I've converted that to an annualized growth rate for each quarter. On the fourth line, there's something called gross domestic income. That's interesting because it's an alternative way to measure gross domestic product. And in theory, GDI and GDP should be exactly the same. You can tell in the table that they're not exactly the same. And so that means there's measurement issues in one or the other or in both. And those measurement issues are particularly large this year. Okay, so the discrepancy between GDP and GDI is unusually large right now. Then I have retail sales. That's a total retail sales in the US. That's a nominal statistic, meaning that it doesn't correct for inflation. So one of the reasons those numbers are bigger than the other numbers in the table is because when prices go up, that inflates the value of retail sales just because the prices went up, not because the quantities went up. The other statistics are real. And then in the bottom 2 rows, those are not annualized growth rates. Those are just the levels of some important statistics just to get a baseline on things. So the unemployment rate everyone's interested in, 3.6%, 3.5% are very low levels by historical averages. So that is consistent with what Nicolas was saying, that the jobs market has been, the labor market has really been quite strong in 2022. That number did tick up to 3.7% in October, I'll just mention. And then capacity utilization is also quite strong. This is a measure of how intensely are manufacturing plants in the US running. 80% is a high number, and so they're running quite hot. So the manufacturing economy is really doing still quite well in 2022. So there are 2 things I want you to take away from this table. The first is that there's a clear outlier in the table, and that outlier is GDP. Okay, so if you look, all these numbers should be more or less the same, give or take a little bit, and GDP is not. Those numbers are surprisingly low, and there's just almost certainly measurement issues going on with GDP. The second thing I'd like you to take away is that there is some evidence of the economy slowing down a little bit in the third quarter. If you look at all of the statistics other than GDP, they're all starting to slow down a little bit in Q3. So again, don't focus so much on GDP. A lot of people got hung up on those negative numbers in Q1 and Q2. A lot of people might be breathing a sigh of relief in Q3. I think that's also unwarranted. If you look at the other numbers, they are slowing down. So the takeaways I would mention, GDP is a broad measure of the US economy. That's why it gets so much attention. But remember, GDP is a volatile economic indicator. It varies a lot from quarter to quarter. Those statistics get revised a lot. And we know they will be revised again in July 2023 and July 2024. Given how much of an outlier GDP was this year, the GDP statistics, those numbers are sure to get revised to be positive. So those negative numbers are going to go away. So those negative numbers are just fictitious at this point. Current GDP estimates are clear outliers, so remember that. Remember, a recession is a time of widespread economic contraction. If we were in a recession currently, you would see all of those indicators contracting instead of growing, like essentially all of them other than GDP are. So you would see evidence of a recession across a wide variety of statistics. So I would conclude the US is not currently in a recession. But as I mentioned, there is some evidence that the economy is starting to slow down. You see that in Q3. We saw that in the October unemployment numbers, and the jobs growth numbers were a little bit slower in October as well. My final slide, let's talk a little bit about the economic outlook for 2023. The Federal Reserve has raised interest rates substantially this year, and they will raise them substantially further. They've been very clear about that. So economic growth in 2023 will surely be slower than it has been in 2022. Okay, so just because I don't say we're in a recession currently, the outlook is going to be for slower growth. Remember, slow growth does not necessarily imply that we will go into a recession. We could just have slower growth for the next year or two, and that's the Fed's intention. They very much intend for the economy to grow slower, and they would like to avoid a recession. Remember, a true recession is a time when everything is contracting. So output is contracting, unemployment would be shooting up, jobs would be contracting, you'd have less jobs every month instead of more jobs every month. A recession really requires some kind of economic disruption. So the COVID pandemic was an obvious one, a gigantic disruption. The financial crisis in 2008 and 2009 was another great example. We're not really seeing that kind of disruption now, and there's not really anything on the horizon either. If anything, as Gary mentioned, short-term real interest rates are still very, very low by historical standards. They're really even negative if you look short enough on the horizon. That's not disruptive at all, even though the Fed's raised rates, that's not disruptive at all because real interest rates are still very low. In fact, you could even argue, as Gary did, that it's still really very stimulative. So we're a long way from disruption. In fact, real interest rates are maybe still in the stimulative region. They're not even contracting the economy sufficiently at this point. So you might say I'm very optimistic about the US. I mean, yes and no. I don't think we're in for a recession. I think it's possible, but it's not that likely. I do think the outlook in Europe is much, much worse than in the US. The main reason for that is the US is essentially energy independent. Europe is very far from being energy independent, and there are very severe energy market disruptions going on in Europe. And those are only going to get worse as the weather gets colder there. So I do see a recession in Europe probably starting, probably already in progress and going to continue for several quarters. I would also worry about the outlook in China, that there are these very disruptive zero COVID lockdowns that have shown no sign of ending, although I guess they're talking about trying to ease off of them soon. But just today I saw some news. But in general, these are very disruptive policies in China, which make the outlook in China also pretty worrying. So let me stop there, and we can start doing Q&A and discussions.
Yeah, no, that's great, Eric. Obviously, of course, the Bank of England has been raising interest rates, and central banks internationally have been doing so in kind of a coordinated effort. Not too surprising. We're very much in a global economy right now. And as you pointed out, we had 2 quarters in a row of negative GDP growth kind of at the beginning of the year, which is classically, a definition for a recession. But we were also all coming out of COVID, and the world was a little, unusual to say the least. And then we've got these unemployment numbers. We're at this, normal level for most people and most industries. And it feels to me, as I'm looking at the economy, that the consumers don't feel a sense of urgency or a risk of concern. But you see corporations, particularly the tech industry, for example, just at the last part of last week, have started thousands of layoffs, 10, 15, 20% of their workforce. Twitter's a whole, different issue, of course, but big layoffs there. And they're responding to increases in their cost of capital. If we go to 5 or 5.5% rates, well, their cost of capital is going to go to 10, 11%, and it could even go higher than that, as we know. So they're trying to preserve profitability, trying to preserve cash. We know what happens to the capital markets 12 months, 18 months from now, if we really do start to kind of hit a dip. How do we model these things and think about these things? Eric, I'll start with you, just because you were right on this subject and some of the international influences too. How do we think about those things? You sound a little more optimistic than a couple of our other panelists here.
I think Nicola and I are probably similarly optimistic, and maybe Gary's a little more pessimistic. But
and Janet Yellen too said a week ago or 10 days ago, she saw no sign of a recession coming, whatsoever. And she's an important voice out there.
Yeah, so I would say a recession is a risk, but I would say the baseline scenario is more of a soft landing, like Nicolas is saying. Now, what you said is correct. The Fed is raising interest rates. They're making it more costly for firms to borrow, and that is slowing the economy down. I mean, that's for sure, and that's deliberate. You know, the Fed is trying to slow the economy down to reduce the inflationary pressures. So you will see more layoffs than in the past. You will see job growth in the U.S. being slower than in the past, and you will see the unemployment rate ticking up, just like it did in October. So I would expect to see that tick up a little more. For a couple of months in a row, I would expect to see it be ticking up. The question is, is that going to be severe enough? So that's the slowdown, and ideally that would be the soft landing. You would only get a recession out of that if it really starts to fall apart. If you see just the layoffs just spreading throughout the whole economy, right? Not just a few firms in Silicon Valley, but really just widespread across the country, then you would really start to worry. You'd see the unemployment rate starting to skyrocket instead of just ticking up. So I see no signs that we're hitting that falling apart stage. Right now, everything looks like a sort of more orderly slowing down of the labor market.
Right. And Nicolas, the stated goal of the Fed is to get inflation down to 2% or thereabouts. And you showed a great slide that had a forecast of where you think unemployment is going to sort of settle out. Did those two things reconcile? Do you feel good about unemployment at those levels when we brought inflation down and rates up?
Well, I think I really appreciated all the points that both Gary and Eric brought up, because these constantly enter internal discussions to try and assess, what are the facts on the ground and hardly likely to evolve going forward. I mean, it is a highly uncertain situation with a lot of risks. And I mean, to your question, part of one of the risks that the Fed is trying to disentangle are what components of current inflation are driven by excess demand or supply shocks. So the war in Europe is an example of very negative supply shock. This is a problem that Europe's facing, kind of echoes why Eric is concerned about Europe. It's a very strong negative supply shock that is very costly to as a central bank to fight in order to bring inflation down, because it's also slowing down economic activity in its own right. Here in the US, our internal assessment is that Adam Shapiro has shared publicly. So I think our estimates are that about half of current inflation are driven by demand. That gives a lot of scope for the classic slowing down of the economy through monetary policy to bring inflation down. Of course, there are risks to that, and there's always a risk to that outlook. We've been surprised in the past with the duration of inflationary pressures, the continued problems in China with their zero COVID policy causing supply chain issues. But U.S. households are in a very good position right now. Jobs are plentiful. They were able to rebuild their balance sheets. And one might say the same thing for firms as well. They're in a relatively healthy situation going forward to face what may be coming in the near term.
Mm-hmm. And thank you for that. And Gary, you pointed out some unusual activity when we think about the long history of economic cycles here. Are we in a different kind of a cycle? Can we expect some of the things that we've seen in the past to repeat here, or are we in kind of uncharted territory today?
So we wish we knew that, right? So there's some, I guess, on the kind of demand side and the inflation side of the economy, there's one thing we cycle we could be in, we hope we're not going to repeat, right? In the 1970s, I think most of the scholars now think that primary source of the inflation was that the central bank, right, the Federal Reserve, provided too much stimulus to the economy that kept the real rate too low for too long, and they had a kind of unrealistic expectation of what the natural rate is, right? So they kept unemployment too low, and they were really shy about taking actions to slow inflation, which might raise unemployment.
Right.
And you let the problem fester. The longer you let inflation go, the more costly it usually is to wring it out of your system. So, so here there's a danger that we kind of repeat this mistake, that we're too optimistic about our ability to get a soft landing, or we're too worried about seeing a little bit of unemployment, and so we don't get rid of the inflation in the next, it's going to take us a couple years realistically to get inflation down. But if we somehow back off and the central bank loses credibility as an inflation fighter, like we did in the 70s, then the length of this inflationary episode could get much longer, and the eventual pain could get worse. So I'm pretty trusting of the central bank in the US, like the Fed's leaders, to take care of this problem now. And they've signaled that they're just going to keep raising interest rates until inflation goes away. But we'll see what happens on the political side of things, because the Fed ultimately responds. It's an independent agency, but its independence is conditional on what our political system, how much independence we want to give them. The other issues, right, it's on the supply side. So there's a bunch of shocks that out there that are severe, that could be temporary in the sense that they're going to last a year or two, or they could be permanent in the sense these particular shocks might last a year or two or three, but then a lot of shocks just like them are going to come down the pike. And if you talk to people, the kind of politicians or people who are living in Eastern Europe today, they think this problem with Russia, right, this is going to be a long-term, a generational thing, that they're going to be they're arming themselves to fight the Russians, not just this year and next year, but repeatedly. I have a lot of family in China, and what they're telling us is, what you see is that, China's arming. There's an arms race started in Asia, with Japan is rearming, Korea is already armed to the hilt, right? China is building the size of its military very rapidly. We haven't seen an expansion of a national navy like this since the naval arms race in the first decade of the 20th century. And and China, she is moving to cement political control and bring back this central role for the Communist Party.
Right.
They're really pushing nationalism. So conflict in Asia could lead to much broader disruptions of the international economy than what we are seeing with Russia. And so if the supply shocks are permanent, then our central banks got to make a decision. Are we going to absorb these permanent supply shocks through a lot of inflation, or through having a big recession, right? And we don't have other way to deal with this. But you have to make there's two bad choices. And but we just don't know. We're not. A lot of these supply shocks have political origins, and it's very hard to predict where the politics is going to go. It's very contingent on part on human nature and its unpredictability, but part on the particular leaders of a very small number of people who we don't really understand what their motivations are and what they're doing, and how they're going to interact with the other senior leaders in their country. So I think there's a lot of uncertainty in going forward here.
Yeah. And that's why we need economists in the world. And so North Korea just fired another ballistic missile, tested another missile, and there's plenty of instability. We have just a couple more minutes because I want to leave some time for Q&A here at the end. But just real quickly, in just a sentence or two, how much of the international activities are impacting what's going on here domestically? Eric, I'm going to start with you. Just a couple sentences about how, what's going on internationally. Is that really impacting us here? And if things go bad there, are things going to necessarily go bad here?
So the main impact is the oil market. So you have the energy market disruptions coming from the Russia-Ukraine conflict. Russia is, I think, the number 2 producer of oil in the world. And that is now off limits to most Western economies. So you're getting an increase in the price of oil because of that supply cutoff. And so, I mean, the US is fortunate. We're mostly oil independent now, and we're clearly natural gas independent. So we don't have to worry about that much, but it's a huge issue for Europe, right? You see, Europe has an energy crisis going on because they can't get much oil from Russia anymore, really. The other thing, supply chain disruptions, those are sort of winding down. I don't see a lot of other, if there was a military conflict, that would be a big deal, but that's not going, an additional military conflict other than Ukraine, Russia. I don't see that going on right now. So it's mostly just oil.
And Nicolas, how do you guys think about that when you're doing your own planning? How much do international events enter into your thinking?
Well, it's just in a couple sentences where the Federal Reserve is focused on sustaining the US economy, and any information that is material for the US outlook comes into the analysis. And so that encompasses what's happening abroad and the potential risks that Eric and others have highlighted.
Great. Gary, anything to add?
No, I think Eric really hit on it, kind of the short run, right? The oil is affecting our economy. I would say this is largely a political issue in the long run, and it's going to be more so. The world's largest known oil reserves, right, are in Venezuela, Iran, Russia. Now there's a lot in Saudi Arabia and the Middle East. We used to get along with them, but the largest known oil reserves, most of them are in countries that we have very bad political relationships with, and we're using our military or our political power to block their oil from the world markets. Now, the US, we're oil and energy independent now, but at current extraction rates, our known reserves are going to be gone in less than 2 decades. Now, we'll probably find more and expand, but so this is the politics and the economics around oil have been tightly intertwined for all of my life, and I think it's going to get even worse and more unpredictable, right, as we go forward.
Indeed, these are big and very important issues, and go to affect so many people. I do want to just stop here for a moment. I'm going to hand things back to Bill before we say goodbye here at the end. We've got questions coming in from our guests today, and we'd love to hear what those are, and they'd love to hear from you guys. So Bill, over to you.
Great, thank you. Well, a lot of them I think have been covered just in the past few minutes. There are a number of questions about different kinds of disruptions on the horizon. Let me just put one out that hasn't come up yet, and this is from Jerry Brockman asking about the UK gilt crisis and what your thoughts are there, both in terms, I think, of the UK context, but then also any potential impact over here. To whoever wants to take that.
I'll say a sentence and maybe someone else can, but I mean, I think it's primarily a UK issue right now. And so it's the spillovers to the US are really, really minor. The treasury market's not that connected to the UK gilt market, really, certainly in terms of liquidity, it's not. So it seems to be more of a UK specific disruption that's impacting them. There has been some talk that if the Fed was to raise interest rates, there's some concerns that as losses in the treasury market mount, as the Fed raises interest rates and treasury securities decline in price, you could see some declines in liquidity, especially if the increases in interest rates continue to be very large for many months to come. And then you could start seeing a similar kind of crisis here. I don't see any spillover from the UK to the US, but I guess you could see a similar crisis unfolding here, and so the Fed would be watching for that closely.
Thanks for that. There's also a question here from Kevin Weaver. Isn't there an argument that the Fed has already lost some credibility in being slow to act, which in turn makes it more difficult for the Fed to convince/justify their actions to people and businesses now? So the credibility question. Whoever wants to take it. Nicolas.
I mean, I can take a first, and then Gary's, I'm sure, might have a historical perspective, but credibility and trust is earned. There's no doubt about that. There's a social contract with Americans that is gained through delivering. But one area that you can look at are expectations of inflation by businesses and households or markets. And if you look at inflation expectations 2-3 years out, especially 5 years out, credibility by that measure seems to have been maintained. And 5 years and beyond, inflation expectations still are well anchored at 2%. Now, over the last year, through the policy actions that the FOMC has taken, we've seen inflation expectations at shorter horizons begin to come down. And of course, the very short horizons, especially from household surveys, are very influenced by prices that people see every day, prices at the pump. And so when prices at the pump go up, inflation expectations in the near term tend to go up very quickly, and they come down very quickly as well. But by broad sets of measures that the Federal Reserve keeps a very close eye on, credibility in terms of maintaining price stability appears to be well anchored at this stage.
Yeah, I'd echo what Nicolas said. So the Fed's credibility, the way we measure it, looks still very solid. And I would reverse the questions kind of segments. I'd say the fact that the Fed has such great credibility as an inflation fighter has allowed it to move slowly, which is what you want the central bank to do. You want the central bank to be able to focus at most points in time on dealing with unemployment and keeping the economy operating near potential, right? And the central bank can do that much better if people believe that it will keep inflation stable in the long run, but not worried about it necessarily month in, week by week, month by month. So we've benefited a lot from the Fed's credibility, and now we're sort of the Fed's leaders understand this, and so this is one reason that they've repeatedly stated public they're going to do whatever it takes to get inflation back to target in the long run. And we're hoping that they're not going to have to do that much, right, to get inflation stabilized and the economy won't suffer a recession. The big question will be if a year from now or a year and a half from now, inflation is still running strong and we're still seeing more of these negative supply shocks and other more stimulus potentially from the fiscal authorities, and then the Federal Reserve has no choice but to keep raising rates and trigger a recession, right? That's going to be the test of the Fed's credibility. Will we keep prices and inflation stable even if we have to suffer a recession? Right now, markets say yes, right? That the market is telling us 5 years, 10 years from now, the inflation rate is going to be 2% no matter what, which means there will be a recession if we need one to keep the inflation rate stable. And hopefully we don't need that test, but we might see that test in a year or 2 years from now.
Great, thank you. We're just on the hour now. So Peter, let me hand it back to you to close us out.
Great, thank you so much. It would be interesting to check back in a couple of quarters or in some period of time and see how things are going and reevaluate our estimates. There's obviously a lot to unpack here, and this has been a great conversation. We could keep going well past the hour. I want to thank Bill Maurer for inviting me to come and moderate this today. It's a delight to be at UC Irvine. I'm glad we're doing this. And Bill Branch, thank you for your help, and everyone else involved who helped coordinate this. And a very special thank you to our panel today for preparing for this and coming and sharing slides and sharing your thoughts. It's really terrific. I love these conversations, and I hope our audience got a lot out of it as well. So thank you all very, very much. And stay tuned. Maybe we'll do one of these again at some point. And delighted to share this time with you. Have a wonderful day, everybody.